Thanks so much for being here with us today. As Wasim mentioned, I'm Katie Myrick. I'm our GM of Consumer Goods and Retail at Pilot. And today we're really excited to cover with you how to approach the fundraising process, what to consider in terms of timing, what you need at various stages of investment, what investors are really looking for. And then we'll also share some highlights from Wasim's founder story, lessons that he kind of learned from going through the fundraising process. And then at the end, we'll open up to questions. So feel free to use the chat or the Q&A box, and we'll make sure to reserve time for that at the end. So by way of quick introduction, I lead Pilot's consumer goods and retail practice. And at Pilot, we support companies with all of their financial needs, bookkeeping, taxes, budgeting, KPI management, of course, fundraising, and more. I myself come from an operating background. Prior to Pilot, I was the COO at Boba Guys and Tea People, so pretty intimately familiar of how to scale kind of a multi-channel retail and consumer goods business. And at Pilot, I support all of our similar consumer companies across all of their stages of growth. So all the way from pre-seed, pre-launch, some entrepreneurs with an idea, all the way to kind of later stage rounds and beyond. I'm super excited to be here today with Wasim. He's our CEO, and we'll be discussing the successful paths to raising venture capital. I'll let him introduce himself and tell you a bit more about Pilot too.
Thanks, Katie. I'm very, very excited to be here with you all today. And as Katie mentioned, I'm Wasim. I'm Pilot's co-founder and CEO. Before Pilot, I actually founded two other companies with my same co-founding team, Jeff and Jessica. Our first company, K-Splice, was acquired by Oracle in 2011. And our second company, Zulip, was acquired by Dropbox in 2014. And happy to talk a little bit more about both of those. But first, I want to tell you a little bit about Pilot, which we started over 4 years ago at this point, basically in January 2017. As Katie mentioned, our specialty really is bookkeeping, tax prep, CFO services, budgeting, forecasting, et cetera, specifically targeted at startups and small businesses. And when you work with us, you're paired with your dedicated finance expert. There's your trusted partner who takes the work off your plate so you can focus on your business. And actually, Pilot is now, I guess, what we call a unicorn, valued at $1.2 billion after our most recent fundraise led by Sequoia, Bezos Expeditions, and a lot of other great folks. So very, very excited to be here today.
Awesome. So now that we know a little bit more about kind of all three of your companies, let's talk about maybe the first most important question. How to decide if you want to go for equity fundraising or not in the first place. Can you talk to us a little bit about Pilot versus maybe your experience at K-Splice? How did you know kind of that you did need to raise, and maybe when was a good time to raise?
Yeah, it's a great question. And the three companies we did took very, very different paths. So at K-Splice, our first company, we didn't raise any money at all. We bootstrapped the company. The way we got it started actually was a little bit of money that we got by winning a business plan competition and applying for and receiving a government grant. And that was sort of the only external funding we ever received. All of our other growth was fueled by revenue that we generated from selling a product to our customers. And we ran the company for 3 years. We got it to 7 figures in revenue. And as I mentioned, it was acquired by Oracle. Whereas the path for our second company, Zulip, the fundraising process was a bit different, with the acquisition, that initial acquisition under our belt, with kind of more of a track record from the team, and also really sort of aiming much bigger than what we were targeting. It felt like a business that was right for venture capital. And so we raised a little bit of venture capital funds to get it started. And actually, I want to talk about that a little bit. What are the elements that make a business right for venture capital? And I want to caveat all of this by saying there's no right answer. It's not like it's good if you're a good fit for venture capital, it's bad if you're not. There's different ways to grow a company. So there's no judgment here, but I wanted to kind of talk a little bit about the elements that I think venture capitalists look for when thinking about this kind of equity fundraising. The first and the most critical element is that the market has to be super, super, super duper large. Like if the market is not billions and billions and billions of dollars a year are spent on this thing, that's probably not going to be a good fit for the venture capital model. Because the venture capital model fundamentally is we invest in 100 companies, 99 of them totally fail, but the one that succeeds, is like 10,000x. And that's why in aggregate, we have good returns for our whole fund. And so if you have a business where the success case is like it's going to double or 5x or 10x, like that might actually make you very happy as the owner of the company. And I think it should, but it's not actually the right shape for a venture capital investor. So requirement number one is that the market is super large. And then requirement number two is that you, the kind of founder or owner, have an appetite to grow really quickly at the expense of trading away ownership in the company. Because that's ultimately the deal you're making. You're saying, I'm going to take this money from investors, and in exchange, I'm going to give them a very material chunk of ownership and control of my venture. And the reason I'm doing that is because I believe that with this additional capital, we can grow bigger, grow faster. In aggregate, the more value will be created here. But if you think that's not true, if you're not set up to, or you don't have the appetite to do that super fast growth, also probably not a good fit for venture capital. And so for context, if you look at our second company, Zulip, it was a group chat for businesses. We were trying to build something like Slack. And I think we have all kind of seen just how large that opportunity ended up being. It's the right shape. It's like, well, if every business in the world buys this thing, like, yeah, of course, it's a huge business. And the same is true for what we're doing at Pilot. Like every company in the world needs bookkeeping, tax prep, help with budgeting, forecasting, CFO services, all that good stuff. So we knew we were tackling a truly enormous opportunity. And so it made sense to raise money and kind of accept the downsides of raising that equity capital to allow us to tackle that opportunity more aggressively. And I think ultimately that's the question I would ask, which is, does your business require venture capital to grow at the rates you'd like to grow? And if it doesn't, I mean, honestly, I think that's a good thing. Fundraising really is a necessary evil. It's not an accomplishment you should be proud of. It's a thing you have to do to cause your business to succeed for a certain shape of business.
Yeah, seems like a kind of a formulaic approach, right? Large market, desire to grow quickly, willing to trade away some of the ownership. What are some other questions you might ask to determine if a business needs venture capital specifically, as opposed to other forms of capital that might enable, different shapes or speeds of growth?
Yeah, absolutely. Because venture capital is not the only, game in town. There are other ways to fund your company. I think the most important question in determining whether venture capital is right for you is, what kind of company do you want to build? As I mentioned, VC comes with very steep growth expectations, and you need to be ready to sign up for that if that's the route you want to take. Or so if you're looking to build more slowly, or your aspirations are to have a lifestyle business, and I don't use that term pejoratively at all. I think that's actually a great thing to have. Or the total addressable market simply is not that large, even in the success case, venture capital is probably not the avenue for you. And then I think the other thing to remember is venture capital comes with a loss of equity and a loss of control. There'll be more stakeholders with a say in how you run the company. And that can be good because it can be a terrific source of advice, of experience, of mentorship, or it can be really bad. They can steer you in directions you hadn't planned on going. They can force you to do things that you don't think are right for the business. They can block the sale of your company to a buyer that might be a really good fit for you. There are all kinds of bad things that can also happen as a consequence of this. And so I think being very clear with yourself on what your goals are should help determine the source of capital that you should ultimately seek.
Makes sense. Obviously, with Pilot, the three of you did decide to pursue the venture path, and you raised the seed round, I think, just from folks in your network. I think it'd be great to hear for folks about the Series A fundraising process. When is a good time in particular to think about your next round of funding?
Yeah, and so I'll caveat all this advice with, again, this is kind of oriented at the startup venture capital approach to fundraising, but I think there are nuggets here that are generally applicable, which is that really you want to have at least 6 months of runway left when you start fundraising. And so what is runway for a second? I mean, this is a very classic kind of startup stat. You say, how much cash do I have? And then how much am I spending every month, kind of net? That's called your burn rate, what you're spending. And then you divide it. So you take your cash, you divide by your burn rate, and you say, okay, if I keep spending at the rate I'm currently spending, I will run out of money in 9 months. So fine, my company's runway then is 9 months. And the more runway you have, the easier your time will be because you have more flexibility. So if possible, if you can have 9, or as the slide says, even 12 months of runway, when you start to think about the fundraising process, that's even better. And the reason, like, why do we need so long to do this? Well, I think there are 2 reasons. Reason number 1 is if your investors know that you're desperate because you're about to run out of money, though, like, the car is running on fumes, you have no leverage in the conversation. Like, you're desperate and your investors know that, you don't have any other option. You're not going to get the terms you'd like to get. And the second is that, unfortunately, fundraising always takes longer than you think. And again, if you're kind of like right at it, I'm about to run out of money, it can put your company in a very tight spot. So we always recommend really having as much of a buffer as possible. But I think the other thing that people maybe don't think about as much as they should is that it's important to be thoughtful about how much money you raise. And there's a little bit of a kind of meta game going on here, which is when you raise money, like why are you raising money? You're raising money to get to one of two endpoints. You're either raising money to get the business to profitability so that you don't have to raise money in the future. Like you still may, but you structurally don't have to if the company is generating a profit. Or you're raising money to get your metrics to a point where you can raise money again. And so when you're raising your seed round, the question is, okay, fast forward, imagine yourself raising your Series A. What are the metrics you're going to need to hit to cause that to occur? Like, oh, I need to get to this amount of revenue run rate, or I need this many customers, or I need margins to be whatever. Like, imagine you're raising your next round right now. What does your business need to look like? Then you need to ask, okay, how long is that going to take me to get there? And what resources do I need to do that in terms of personnel, time, equipment, etc.? And that comes up with like, okay, it's going to cost me $2 million. I'm making this number up, $2 million to get my business to a point where my metrics would be good enough to raise a Series A. And then I'm going to multiply that number by 1.5 because I want to give myself a healthy cushion. And really, that's how much you should raise in that initial seed round. So in some ways, figuring out how much to raise now requires you to think ahead to what the next fundraise is going to look like and make sure you can actually get there. Because the problem is if you're spending your money and you don't get to either profitability or to a point where your business is good enough to raise initial money, like now you have a real problem. You're out of cash and your company's kind of unfundable. So you need to sort of think ahead there.
I think having been through this multiple times, we've talked about how as you get deeper into the process, there's more and more moving parts to produce and to polish and all that. So I guess between the pitch versus the underlying model or financials, where do you see most companies really reach hurdles? Like, is it really more about the storytelling? Is it more about getting everything under the hood really airtight? Like, where would you invest most of your time?
This is a little bit of an unsatisfying answer because the answer is kind of both. But if I had to pick, here's what I would say. Ultimately, it's the story that sticks. So I would definitely invest heavily in the pitch, both in the written deck, but also in your own delivery of it. That said, especially for later stage funding or kind of alternative funding sources that are not venture capital, the more concrete results and metrics the company has on hand, the better. And investors are going to expect to see more rigor in everything under the hood. Meaning, okay, you have some kind of historical bookkeeping that should be airtight. You should have clear commentary on kind of why things were the way they were. You should be able to explain the key levers and assumptions and any forward-looking models as well. So you need the story, but you also need the rigor to kind of back it up for when folks double click a little bit deeper.
For sure. Aside from the timing, what were some of the really major considerations for you all? At Pilot, we kind of really advise our companies both on the pitch, the storytelling, even the delivery, and of course also the financials or the KPIs, benchmarks, your forward-looking projections. But what do you feel like for you specifically going through the process? Like, what helped you stand out the most when you were actually in those investor discussions?
Yeah, that's a good question. I mean, look, again, at its core, I think fundraising is storytelling. There has to be a compelling story. Why should your business exist? How staggeringly large will the company be once you succeeded? What will the world look like post your company? And then why are you the team to do it? I think those are table stakes elements. If you don't have those elements of your narrative, like, it's not going to work. Now, assuming you do have those pieces of the story, what you will find is that your potential investors will pretty rapidly identify for you the areas that they have the most concern about. And that's where you're going to want to spend the most time in your pitch. And I'll give you a very concrete example about actually Pilot, our own company. So in Pilot, the thesis again of Pilot is like, look, when you work with us, we're basically your external accounting and CFO firm. We're going to do budgets, forecasts, projections. We'll help you with fundraising. We'll help you with taxes, da, 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 da. And the way that we do it, the thing that's interesting about Pilot is we have this team of full-time employees who sit in our office who are deep experts. And then we also have an engineering team, and the engineering team builds software that makes sure that the work that we do, that we use internally, is super accurate, super high quality, super consistent, et cetera. And so you're an investor, you hear that story, you're like, love it. Everyone has this problem. I love that you have this team of experts. It's clear you're going to be able to deliver a real white glove service. But tell me about gross margins. Like, it sounds like this is very human labor intensive, and all of your people are these full-time US based people. Like, that sounds really expensive. And can you demonstrate to us that this business is really going to have good gross margins with time? Or is this just going to look like a big accounting company? And so to tell that story, we had to go really deep into our own KPIs, our own projections that were related to margins. Like, we got quite in the weeds there. And importantly, we didn't just like wait until someone asked about margin. We knew they were going to ask about margin. So we incorporated those elements directly in our pitch. If you know you're going to get a particular question, just like nip it in the bud as you talk about your company, because you'll be able to control the framing and the narrative of it. And your investor will be like, oh, wow, yeah, great. These folks are thinking about the same things I'm thinking about.
Yeah, makes sense. As I think about my past fundraising experiences, often that metric was changes to the lifetime value. Are you really able to retain all these customers that you worked so hard to acquire in the first place? Are you successfully getting them to buy either more of what you're selling or other things that are in your product portfolio? Especially since customer acquisition costs tend to go up over time. So as you kind of penetrate your organic channels, making sure that that really keeps pace tends to be a really critical area that investors are diving deep into.
Definitely.
Well, I want to dig into kind of a different area where I think you, Jessica, and Jeff have done incredibly well, which is really knowing what success looks like at the different stages of the company. Can you talk a little bit about how to think about the positioning when it comes to taking on those future stages of investment?
Yeah. And so again, this is a sort of diagram about the kind of classic venture capital approach to fundraising, but I think there are elements of this for every company's narrative, which is investors are evaluating different things at different stages of the company. In the very earliest days with your pre-seed or your seed round, because the company is just getting started, you don't have a lot to show for yourself in terms of traction. And what that means is that your investors can't make an investment decision based on like revenue or margin or some concrete metric. They instead have to look at these things that are sort of proxies for maybe whether you'll succeed or not. Like, how big is the market? What is the caliber of the team? Is the team well suited to actually solve this problem? How much initial customer interest has been demonstrated? In other words, they'll really tease out elements about team and then vision. Now, when you look at the subsequent round, if you look at the Series A, it's now about product market fit. It's okay, you have a great team, you have a great vision. Have you actually built a thing that people love? And do the metrics indicate that people love it? So we might be looking at customer attention or net promoter score, et cetera, et cetera. In the next round at Series B, the question is not, do you have a good team? Do you have a good vision? Is there product market fit? It's, will you be the market winner? Are you really going to be able to scale this thing up? How efficient is the sales process? What is lifetime value? What is cost to acquire customer? What is organic growth looking like? Is it beginning to tap out or is it accelerating? There's a lot of the like, are you going to be the market winner that kind of digs in here? And then beyond that, in subsequent rounds, it's really about much more classic metrics like, cash flow and EBITDA margin, liquidity ratios. And like, you put stuff in a spreadsheet, out pops some numbers and you say, yes, this is a healthy business, or no, this is not. And so when you're raising around, it's important to make sure you've done the homework needed to speak to the specific stage appropriate things that your investors are looking for. And actually, this is one of the areas that our team spends the most time on with our clients at Pilot, which is like, okay, what is the right story to tell for a company of your stage?
Yeah. Well, Wasim, thanks so much for the insights. I want to make sure we have enough time for opening it up to questions. I know we got a handful of them ahead of time, and then I also see a few coming through. Maybe a logistical one that I'm hoping the FounderMade team can also chime in on is what's the best way for us to share a copy of the presentation with the folks attending? So I don't know if Michelle or any of the FounderMade team wanted to weigh in on that, but if not, I'm sure that's something we can figure out with them after the session and make sure folks have access.
Yeah, or folks, you can just send me an email just with Wasim@pilot.com and we can get you a copy.
Awesome. Well, I know one question we get a lot at Pilot as well is, if you if you already have more than enough runway, you're kind of sitting in a really healthy place. How opportunistic should you be about fundraising? If VC comes knocking at your door, but you're not in a place where you normally be thinking about fundraising, do you kind of strike while the iron's hot, or how do you approach that?
First of all, great problems to have, right? I mean, would that we could all be so fortunate that people like want to give us money and we're not sure if we should take it. But here's how I would think about it. And there's something like a little bit perverse going on here, which is in some ways the easiest time to raise money is when you don't need the money. And this is kind of to my point previously, which is if you do need the money, your investors know that you need the money and you're desperate, and it's therefore hard to secure funding on terms you're looking for. Whereas if things are going well and you're well capitalized, the business seems promising, you don't need money, but that's sort of precisely when people want to fund you. And so the thing I would think about in general is like, look, the cost of this capital is not cheap, both from your time or your ownership or your equity. It can represent a very big distraction. So the question I would ask is, if you had the additional capital, could you deploy it to have the business be more successful in some way? And if so, then yeah, I think you should consider, so like, if we have this additional capital, this is what we're going to do. It's going to let us grow the customer base. Like, cool, go for it. Raise that additional funding. If you're like, well, we're just going to raise it and we're just going to stick it in our bank account and like sit on it, then probably it's not that useful to raise. So I would really be thoughtful about, can I actually deploy this well?
Yeah, as we already talked about, right? It comes with those steep expectations. So being ready to take that on and knowing where you're going to put it seems like a pretty critical piece of the puzzle.
For sure.
Um, what about kind of at the earliest stages of the process? Obviously, the investment, your relationship with your investors is just that. It's a relationship, right? It's not just a check. So what are some things that you look for, especially in your earliest investors? Like, how should folks go about thinking about, who's on their initial list of names to think about reaching out to?
Yeah, so it's a good question, and I would look at two specific things. I would look at kind of like, how useful do you think they will be to you? So do they have connections in your industry? Like someone who's a current customer or an advisor where you already have a relationship where you know that they can be helpful, that's always a great choice for a potential investor. But the two axes I'd evaluate on are, how useful do they have expertise or industry knowledge or connections or whatever that will help you be successful in your business. But the second thing is also like, it's not quite, do you like them, but do you have a good working relationship with them? Meaning you're going to have to spend a ton of time with these people. And so given that, it's important that you feel like they're on your team, that they get the mission and vision, that they're on board for the journey. Like, I probably talk to our investors like several times a week. And I've done that every week for the past 4 years that we've done this company. And I imagine I will continue to do it for the lifetime of this company. It's like, you are spending a lot of time with these people. Given that, better to take money from people you think will actually help you, who you like working with.
Yeah, I love that. Okay, we got a new question, which is, as founders of the company, we have not taken salaries yet to help keep a long enough runway. We certainly need to begin paying ourselves. Is this acceptable to include in how we will use the funds in addition to the other uses of the capital?
Yeah, I think it is. I mean, look, it's going to depend on the scale of money you raise and from whom and kind of like what you're going to put it towards. And maybe let me give you two examples. If you're going to raise 100K or 200K or something, and most of that needs to go to buying inventory or, something that like is actually critical to make your company survive, it's probably a hard sell to be like, well, we're going to raise 200K, we're going to spend it all on team salaries. Because the thing that the investor would say is, well, like, is this actually going to set the business up for success if you can't actually make those initial investments you need for the product, to get your thing off the shelf or into the market. Now, having said that, like, hopefully your investors are taking the long view here, which is, look, a critical part of the business is, of course, the product is the thing you're making, is the distribution, but it's also the team. And if the team is going to burn out, or the team can't actually continue working, or like you're going to quit and take a job at some big company because like you can't pay your bills, like that is also quite problematic for the company. And so definitely, I think for our company, for example, a big portion of where we look at spending funds is like salaries. It's generally salaries for the team, but of course it's also like salaries for the founder. So I think absolutely, as you think about, what is this money going to do for you? you also need to make sure that you're running the business in a way that's actually going to be sustainable and successful. And I think if you, just to say it explicitly, if the founders or the owners of the business are so concerned with how am I going to actually make ends meet for myself every single day, you're not going to be able to actually focus on making the company successful. And if you're not going to be able to focus on making the company successful, it's not going to work. So I, the investor, look, I don't want you to be paying yourself some like super luxurious big salary. I would like you to be paying yourself a modest salary, but I want to make sure you're paying yourself enough to actually allow you to be focused on making the company successful, as opposed to optimizing for, look, I'm gonna walk rather than taking the bus because I need to save that additional money. Like that's time I would rather you be spending, running the company.
Yeah, it all kind of interrelates, right? Like you as the entrepreneur want to make sure you're looking at that big picture, and you want investors who are going to look at the big picture that way too.
Totally.
Awesome. Well, I know we're down to our final minute. For anyone who wants access to the presentation, feel free to just email us, katie@pilot.com or wasim@pilot.com, and we'll make sure you get a copy. Wasim, any final words of wisdom or any kind of last minute things you wish you knew before you jumped into the fundraising fray?
I mean, the story is so critical. And how do you tell the story well? You practice the story a lot. So I would say, like, make sure your pitch is laser, just super dialed in by practicing in front of a mirror, practicing with your friends. And then don't tell people I said this. Start with like the worst investors, and then like talk to like the investor you most want last, because by then you've heard sort of what other people have, you've got it really dialed in, you've got a flow going. Like you just need a lot of at bats. And then obviously, look, Pilot can absolutely help out with this stuff, both on the creation of the deck, the creation of the narrative, the tracking of the KPIs, all that good stuff. So if there's anything we can do to help, please do drop us a note. Obviously, our contact information is here on that slide.
Including the pitch. I know the CFO team spends quite a bit of time honing that in with our entrepreneurs. So they have quite a lot of practice on asking those hard-hitting questions.
For sure.
Pilot team, you guys are awesome. I'm smiling at a ton of the content that you just came through. It's funny, I went to a conference up in San Francisco a long time ago, probably 10 years ago. And the pitch that I remember the most was the most polished presenter. Unfortunately or unfortunately, right? So to your point, Wasim, I think that, so holds true. Hit those investors that you're not prioritizing first. I think that's a phenomenal advice. It's funny, even doing a day like this, right? As you come on to the session, same kind of feeling. It's warming up the engine. And also the advice around, I've said this so many times to our founders too, so I love that you said it. The best time to fundraise is when you're not fundraising. Investors smell that in the air, and they can feel that, and it makes it that much more exciting. They want to participate. So such great tips. Would love a little summary even after to go out to our community. I think we just covered so much great content.